But with the market right here on 80 now, counting down to what the market opening is going to be today, given the 5.6% fall that we've already had from the October highs. For the index alone. Of course, there has been a stark damage on some of the individual names. I was no different yesterday itself as well. The Reliance news with the Saudi Aramco deal getting called off, that really brought about a bit of a shake-off in Reliance Industries. That said, the market also fell under its own weight because it was not just Reliance standalone, but most other stocks as well were facing the heat, especially the financials and the large cap boys like a Bajaj Finance, Bajaj Finserv, which were both down in excess of 6% at the session lows yesterday. And that was pretty much the case across the banking pack as well. But that said, let's bring on board Pankaj Pandey and talk about what the market texture is going to be on from here. Pankaj, hi, morning. Good to have you on the show. Many reasons getting attributed to the market fall, and this was also the much anticipated correction. To think of it, we've fallen only about 5.5% from the October top. So in that sense, more elbow room perhaps for markets to fall further. But what I want to ask you is, what should be the investor strategy right now? Buy the dip just yet, or would you say keep the shopping list ready at least for now?
Hi, good morning, Aisha. So I think what we have seen is that with 17,500 levels being taken out, we've seen an accelerated correction in the market, and I think our sense is that see we were hoping that 3-4% kind of a correction is what it would sort of pan out, but the correction is a bit longer. So our sense is that probably 8 to 9% kind of a correction is very much possible. So I think 17,000 kind of a levels is what we would expect the bounce will come. And from there on, we would expect that markets could sort of make a new high in the next 1 or 2 months. So it will sort of go past 18,600 kind of a levels. And subsequent to that, for next 1 year, our target is about 20,000 for Nifty. I think earning wise, there's very little to sort of complain because quarterly earnings, Nifty EPS was about 180 against our expectation of 165. And I think macroeconomic wise, there's very little to sort of complain. And I think from sector perspective, banking looks quite attractive from a risk perspective. Beside that, we have seen a decent amount of crack in IT, and IT, I think the outlook remains fairly robust. Reliance also has its fair share of correction, but our sense is that probably you could have some more correction sort of panning out of 3-4 odd %. And that is where I think the buying should emerge. So, which is where I think whether it is large cap, mid cap, small cap, one should be selective. And it's not to say that mid caps are looking more attractive or large caps are not looking less attractive. I think one should keep their shopping list ready across caps.
Besides banks, what would you be tempted to buy in the fall, Pankaj? Or do you buy more of the same, the leaders up until October?
So in banks, if you look at last quarterly numbers, one thing was very common across is that the growth in the housing loan portfolios, what we have seen, so growth was in the range of 15 to 28, 29 odd %, be it banks or be it HFCs. And that's a sort of a secure book to sort of look at. So right from companies or bank like say SBI, which looks very attractive, or the tier one names like HDFC Bank, Kotak Bank. Beside that, HDFC also is looking quite good because it's one of the biggest play on the housing. So that is sort of looking attractive. We also like Bajaj Finance. So it has sort of, we have seen a re-rating of the stock now trading at about 10 times adjusted book basis. But I think we are quite comfortable that lending is a more difficult business compared to payment business. So payment companies sort of going into lending is a bigger challenge compared to a company which is into lending and going into payment business. So I think banks, all the tier one banks, including the PSU banks, look attractive to us.
Right. Pankaj, let's understand what the Vedanta management is trying to indicate here. First, a delisting at 90 rupees, then the commodity cycle reverses, you increase the open offer. When Kane was merged, the idea was to merge entities so that the cash flow of oil business could be used by metal and metal could be used by oil, vice versa, depending on the cycle. Now they want to demerge all the businesses. If that was not enough, there is a buzz that there could be a creeping acquisition of up to 5% at 350 rupees. How should one look at a stock like Vedanta?
So, Nikunj, good morning. The challenge with Vedanta is that it's in a restricted list, so I can't really comment. But coming to metals in general, what we've seen is that Tata Steel sort of correcting about 30-35%, CLS corrected about 40 odd percent. I think this quarter we've seen about 3 to 4,000 rupees kind of a pressure on the EBITDA per ton. I think with the kind of price hikes what they've taken, some of that will get restored. But the challenge again is that for the next 1 or 2 quarters, you'll see coking coal prices impact of nearly about $100. But I think the good part is that China is sort of cutting down their production, so which would keep the prices at elevated levels. So we like Tata Steel, SAIL, JSW is hold because of the expensive valuation it is trading, and beside that, Hindalco is another stock which we like. So metal in general has seen a decent amount of price cut, and our sense is that from going forward onwards, I think things will sort of keep getting better after a sort of quarter or two. And I think probably 1 or 2 more quarters of sort of a sideways movement or consolidation is what we would expect in metals in general.
I'm just going to switch and go back to where Tata Steel or SAIL is headed. Nuresh, Kunal, anybody can pick it up. Has the steel cycle reversed? Because if a stock reverses by more than 33%, then it is a trend reversal. If a stock falls more than 20%, that means it is in a bear market. Tata Steel and Hindalco, they're almost down 15-18%. So is the bear market about to start in Hindalco, Tata Steel and SAIL?
So,
Kunal is waiting for
yeah,
Nuresh. Nuresh is waiting for Kunal. So I'll tell you what,
no,
Nuresh.
I'll take it from there. Nikunj, I believe that a lot of that depends on what happens across the global asset classes on the commodity side. Now, what we've seen in the last 1.5 or 2 months is that many of the commodity asset classes across the globe, they've corrected by I think 15% to 20% on an average. Now, of course, that has played its part on the metal stocks as such. You have the large cap names like Tata Steel, JSW Steel, which have corrected to the tune of 10 to 12% approximately. SAIL, Jindal Steel, many of the other high beta names have corrected much more than the large cap names. To add to the woes of metal stocks, you also have the dollar index, which has been consistently strong. So it's not that the dollar index is spiking up in a very sharp or a swift manner, but it's the steady rise of dollar index which is unnerving the metal the metal rally as such. So I for one believe that we are into a point where like a couple of months back there were so many of the factors which were extremely positive for metal stocks. Everything was just hunky dory for these names, and you saw the metal rally extending itself. And now these factors have changed for them, and which is why you're seeing the stocks as well getting into a corrective phase. Possibly that these stocks may get into further correction over the next maybe couple of weeks or maybe over the next 1 or 2 months, till the time these external factors, they don't try and show any kind of reversal. So we can just expect that the trend would continue for these metal names for some time. These stocks can continue to drag. You would probably see those odd stocks like Vedanta outperforming, and then Tata Steel, JSW Steel maybe going through some bit of selling pressure. But I, for one, believe that if the external factors improve, so for example, dollar index starts to get into a corrective phase, or at least the rally gets into a pause mode, and you see the global asset classes, the commodity asset classes, they start to pick up pace, then you would see the metal cycle turning around. So we have to go with the trend and what the factors have been outlined, and which is why I believe that the metal correction would probably continue for some more time.
I'm looking at Mastec, Deepak Nitrate, Graphite, Loris, Triveni, Webhav Global. It's a long list. It's a very long list. IRCTC down 30%. So Nuresh, let's restrict it to chemical stocks. Balaji Amin down 30%, Deepak Nitrate down 20%. There's a big reversal which is there in Aarti Drugs. Is the party over, Nuresh, in some of the high flyers, especially from the chemical basket?
So I would say either the party is over or we are not going to touch this previous highs for a significantly long period of time. So what we've seen is a blowout move in a lot of these names. So alkyl amines, for example, saw a blowout move very recently in July, wherein it went from 3,800 to 4,700 in quick time. So the top was in place around that time, and since then it has been slowly declining. Similar, say a 3-day pop, a 4-day pop happened in the Deepak nitrite out here again somewhere around the end of September, wherein it went from 2,500 to 3,000 in less than 3 sessions. And since then it has topped out. So we've sort of seen a blowout top in most of the names. Also, the chemical prices across the globe have started taking a hit. And most of these companies, purely on a data basis, there was a time these companies could not get even a 10-15 multiple on the earnings and ended up at 10-15 multiples on the sales. Now, that was the kind of pricing which it had already gone. Institutional holdings went from hardly any percentage points to more than 15-20% of equity with institutions, a lot of it domestic as well. So out here, a blowout top is done. Over participation is also there. So the first case is either the cycle is good and the stock go into a 6 to 12 month freeze period, or they fall 50% from the top. So these are the two possibilities. But one thing is sure, the good times are over for the whole sector.
As the chemical sector peaked out, Nilesh Marani there saying that maybe the best is behind it. Well, these are the top 5 stocks that we're going to keep a watch out for. First up, Paytm. How is it going to perform on day 3 on the Lal Street? First 2 days, it is down a staggering 36% from the listing price. So Vijay Shekhar Sharma telling employees that, remember this also happened to Tesla. The stock was being shorted, so keep a watch on that. Vedanta, you just had Nikun saying that the markets are still trying to figure out the capital allocation policy of this group from demerger. Now it seems it's going to be a case of promoters increasing their stake. Yesterday the stock was higher by over 7% in trade. Bharti Airtel, watch out for that. It's announced a price hike when it comes to tariffs, almost 21% across the board, getting a big thumbs up from the markets. And by evening, it emerged that Bharti Airtel had added 2.74 lakh wireless subscribers in September. We're also keeping a tab on IEX that's going to resume trade with the green certificates. And Society General has sold 4.6 lakh Fino Payment Bank shares. Fino, of course, is another new age company that recently debuted on the Lal Street. Pankaj, if I could ask you about Reliance. We're keeping a tab on Bharti Airtel. What a phenomenal day it had in trade yesterday. Reliance was maybe under pressure, negative sentiment, knee-jerk reaction with the Aramco announcement, but by evening it came out that it had lost a whopping 1.9 crore subscribers. It may be that these were bots, they were not paying subscribers and all of that, but the fact is the markets at one point were counting on those 1.9 crore subscribers too.
So I think so on Reliance we have a hold rating with a target price of 2,900. I think news especially related to O2C business, which contributes about 62 odd percent of the top line, had its fair share of impact. But on the telecom side, we are quite optimistic with the fact that with Airtel hiking tariff in double digits and something which is what will be followed by both Reliance and Idea. On Reliance, I think they're losing subscriber. I think there is a conscious call to sort of increase the ARPUs, and which is why we are sort of looking at lower subscriber base. I think so. A positive way to sort of look at it is that the quality of earnings in the telecom business is going to sort of improve, and which is why I think with the kind of recent crack what would have seen in Reliance, I think the stock is looking good. We see a lot of value accretion happening from the digital ecosystem and the business where they're sort of putting a lot more money. So I think, and you have a number of triggers for the stock to sort of do well. So with the current correction, I think the stock looks good to us.
Okay, that's the call as far as Reliance goes. Yesterday, you did see a negative sentiment on the stock. It was reacting to the OTC business, the oil to chemical business, maybe not being demerged and sold to Saudi Aramco, a 20% stake in Reliance for $15 billion. Paytm, I told you we'll be keeping a close tab on that. The founder Vijay Shekhar Sharma yesterday in a town hall trying to lift the morale of employees, saying, remember, this also happened to Tesla in its first 3 years of listing. The stock was horribly shorted. But after that, of course, Tesla got its game right, became profitable. The S1 did really well. So let's see how Paytm does with a 2-day fall, 36% lower than the listing price. My colleague Harsh gets you the details.
Well, the stock for 197 Communications, which is Paytm, continues to fall. It fell over 13% in trade yesterday. The stock has now cumulatively fallen over 36.5% in the last two trading sessions since it opened up on Thursday. The IPO price for the company was 2150 a piece versus yesterday's close of around 1360 rupees a share. At its lowest point, the company was trading at 1270 rupees a share or thereabouts, which is a loss of over 40% versus its IPO price. The company was valued at 1.5 lakh crores at the time of IPO, and it had raised 2.5 billion US dollars from the market. The issue was oversubscribed 1.9 times despite such a large raise, which is the largest for an Indian company in IPO, with the retail component oversubscribed almost 1.67 times. The market cap has now fallen from that 1.5 lakh crore mark at the time of listing to below the 90,000 crore mark. And over the weekend, the company also disclosed a decent set of numbers for the month of October, with gross merchandise value for the company growing 131% when you look at it on a year-on-year basis, and monthly transacting users growing 35% on a year-on-year basis. The founder, Vijay Shekhar Sharma's net worth has taken a beating as well. He owns around 9% of the company, which was valued at 13,000 plus crores, and he has now lost 5,500 plus crores in this route. He is now valued at $750 million lesser than what he was valued at the time of the IPO.
Indeed, almost a 36% loss since its listing day as recent as just last week, and a 13% loss coming in yesterday as well. Pankaj Pandey, at what price and after how much correction does Paytm become viable for a buy?
So Aisha, we were lead managers to the issue, so I'll not be able to comment on Paytm. But I think in general, for the number of companies which have sort of recently come up with IPOs, I think we need to sort of understand a lot of these businesses more in detail. As of now, from a valuation perspective, I think we are not really comfortable with the number of companies which have come up with the IPO. So I think except for Ease My Trip, we haven't really sort of chased as of now any of the stock. I think, like I said, we need to sort of understand it more. I think the listed space beside these looks a lot more attractive. So that is where we are sort of focusing more on.
Would you, though, be tempted to buy any of the IPOs or the newly listed names if they were to correct further?
The question is to me.
Yes, Pankaj.
So, like I said, whatever we have seen in terms of numbers, we need to understand the business model more in detail. From the prima facie numbers, what we look at, we are not tempted to sort of chase any of the stock, except for one stock, which, like I said, we have sort of initiated coverage, which is my trip, which again we like from the perspective that it's a play on revival in the aviation industry. Along with that, compared to competitors, it's very cost effective. So at a lower scale of operation, it's making profit. And whatever cost heads, if you look at, it's substantially lower compared to the list, compared to the unlisted peers. So that is one which we have looked at. We are still, like I said, evaluating a number of companies, but as of now, really do not have a comfort to sort of track or recommend.
Back to chemical stocks, Pankaj. What has changed there? If earnings is the benchmark, then why Deepak Nitrate or, for that matter, UPL, or why some of the high-flying chemical stocks are suddenly getting grounded? Because earnings is not a problem for them, demand is not on a problem there. Because what is happening in China, some of these companies will gain. If the big picture is intact, why is there such a strong trend reversal?
So, Nikunj, see what if you look at the classic example of say metals, so metals sort of bounce back a lot more earlier, whereas the earnings are sort of looking at or appearing to be sort of peaking as of now. So obviously, you would not see earnings and sort of stock price performance in the same trajectory. And same is the case with chemicals. I think current quarter we have seen ample cases of margin pressure being there, and is likely to be there for the next few quarters. And we've seen a very hefty price performance in a number of stocks. But I think structurally there's some pockets like, say, for example, crabs as an opportunity looks attractive to us. So whether it is PI Industries or Navin Flooring, so these are some of the names I think can be still looked at it from a portfolio perspective. The only challenge is that for the next few quarters, we still expect that you could see a bit of a price or a time correction in some of these names. So, immediate basis, we would not really expect some of these to sort of outperform the market.
I'm just going to shift gears and literally shift gears from chemicals to the new economy stocks. Naresh, let's use the context of Paytm failure as a backdrop to consider that there will be problem for companies in the short term in terms of companies which have a fintech exposure or from the startup world. If that trade is reversing, do you think Naukri could be a great shot? It corrected yesterday, but is the downside now headed imminent for a stock like Naukri?
So, luckily for Naukri, most of the companies they were supposed to come out with an IPO is out. But structurally, yes, we've seen announcement today also in terms of another new IPO being shelved possibly. But technically, Naukri overall structural is still positive. We've seen that move from 5,500 levels to 7,000 plus. Yesterday's fall was a bit of a sharp one. We saw good recovery, but till the time it holds above 5,500, I would be fine with the structure. So one could actually start looking at negatives only once it starts falling below 5,500, not as of now.
Okay, Naresh and Kunal, it's time when we get your top picks from the broader markets. So coming to you first, Kunal.
So, one of the stocks which I'll be recommending would be Ban Escorts. Now, we've known what has happened for Escorts over the last couple of days. The stock managing to show some very strong, solid price performance. Couple of days back on the back of news flow. Yesterday, in fact, throughout the session, Escorts remained more or less flattish, just skirting around the 1800 mark. So I would sense that the stock can see some follow through price action over the next couple of days. Would suggest a buy with 1900 as in target and stop loss to be kept at 1750.
Your top picks from the broader markets.
So that would be a buy on Indiabulls Real Estate. The stock has seen a good correction from 190.95 zones to almost 160. One of the events, which is basically the ex-promoter shares to be sold in the market, is about to be done. Before this, we've seen a good strong base around that 150 mark, and that 140, 150 mark was a perennial problem for this stock for the last couple of years as well. So the retest and the current correction seems to be a good opportunity to lap up at current levels with a stop loss at 150, and I would expect it to go back to 200 in the short to medium term.
Pankaj, wanted to understand, even though you earlier mentioned that banks on a fall would look attractive to you, but just wanted to understand that the fall that we saw yesterday, or for that matter, the last week aside, in not just banks but the entire financial space, what explains the underperformance that we've been seeing in banks at large from in the last 2 quarters alone as well?
So I think see the key issue with banks is that the overall credit growth is still weak compared to the economic growth what you're seeing, and largely because of the fact that since fundraising is easier for companies, so we are seeing a good amount of deleveraging happening. But the good part is that asset quality concerns are behind us, and I think capex cycle probably is still some time away. But our sense is that capex cycle overall will come back very strongly. So, which is why we believe that going forward, you would see credit growth sort of inching up going forward on an incremental basis. That could take probably a year or more than that. But I think with the kind of inflationary pressure, what you're seeing on the job side or other, so our sense is that you'll see a lot more automation being sort of done across sectors, which again is very good for the capital goods sector and again beneficial for banking in general. Besides that, I think real estate is a sector which is sort of doing well, so which is what we have seen in the recent quarter in terms of that particular segment sort of doing well across for most of the players. So I think it's a bit of a sort of a wait and watch kind of a situation in banks. But I think since we haven't seen much of a price performance, the risk reward is attractive. So which is why I think banks looks attractive for the next 2 year perspective.
Okay, Pankaj, great to have you on the show. We'll chat again soon. Burger King